So two solutions, and let me go through them one at a time here. So the first one is a family of investment style. They're both families. They're not point solutions. Family of investing style called revenue-based finance. So here's that chart again, and here's how it works this time. So investors hand over some money. Revenues are growing, and as we can see, the payments back kind of mirror that company revenue line. So in general, what we're talking about doing is asking the company to pay us a percentage of their revenues. This is also called royalties. Sometimes in the world, I'm from Seattle, here we call it revenue-based finance. Other places in the world call it other things. And so we're asking them to pay us a percentage of their revenues. So we know they can pay it because they earned it. This is earned money, not grants, not investment money, money from customers, real revenues. And we're going to ask them to pay us not for a specific amount of time. We're going to ask them to pay us for a certain amount of money. So let me show you what this looks like. There's three main ways to do this. Simplest is just a straight up revenue share agreement. I will give you $100,000 and you promise to pay me 5% of your future monthly revenues. And you're going to keep doing that until I get back, let's say, $200,000. That would be a 2x return. If I asked you for $250,000, that would be a 2.5x return. If I asked you for $300,000, that would be a 3x return. All the numbers in bold and underline are the variables. And so let's just look at this one. It's 100,000 in, 200,000 back, and 5% of monthly revenues. We could do this as a loan. So that wasn't a loan. That was just money changing hands back and forth. To make it a loan requires a time period and an interest rate. That's what a loan is. So I didn't change anything on the top. All I did to make it a loan was I added an extra part to the contract that said, you have a deadline to pay this. 7 years, 10 years, 15 years. And you have a minimum payment to make that's based on the amount of money I gave you. So this is what we do in the US with a revenue-based loan. We throw it on as often 9 years with the IRS minimum interest rate on. And now it's a loan. And when it's a loan, it comes with all the things that come around with loans, like, well, what if you don't pay? Well, if you don't pay, as a lender, right, as me in my investor shoes, as a lender, I can throw you into bankruptcy, right? I can petition the court and request that we have a bankruptcy court take over and a trustee will pay me by selling assets or handing me the company. Right? You can't get that with just a revenue share. That's not a lender. That's just a contract relationship. Third way to do this is the way I do this, which is a way I do it more often than not, which is a little strange twist. It's revenue-based equity. And my fund is the largest user of revenue-based equity in the world. Other funds do revenue-based loans. So here's how it works as equity, right? And just go flip back and forth. It changes a little bit, but not that much. So let's just say the same $100,000. This time it buys a certain number of shares. And in this case, we're going to talk about the shares in percentages, but just keep in mind that when you buy 10% of a company, you're buying a specific number of shares. That percentage just happens to be what comes out of the math. If someone else buys more shares later, you get diluted and all that. But you're buying a certain number of shares, and the company is promising to buy back maybe half the shares. That's what it says here. It could be 3/4 of the shares. It could be all the shares. I like half, right? When I do these deals, I do half. So they promise to buy back half of my shares for, in this case, $200,000. And where's the revenue show up? Well, the revenue determines how many shares to buy back. So we look at the quarterly revenues. We multiply that by, in this case, 5%. And then we divide by the share price that gets us $200,000. And that we then do that transaction. And we do that every quarter until we run out of shares. So it has a max to it because it has a price per share and a number of shares. And this deal would return 2x and then some. Whereas if we did this as a loan, it would be 2x exactly. And the reason why there's and then some, there's a plus sign there, is because we still own half the shares. And so then my contracts would have provisions for what to do with the other half of the shares. Could be that we just wait, just like a normal equity investor. That's not what we do. What we do is we say after a certain number of years, you have to buy back those shares too. For whatever they're worth then, not whatever we put into the contract here. So hopefully the value of those shares went up. And then we have an agreement that they have to buy the shares not in one lump sum, in a manner that we'll discuss at that time, but no slower than this deal here. So if we were doing a 5% buyback, we'll do a 5% buyback on those shares unless you want to buy them back quicker. All right, and that's it. Those are the three main ways to do this. It's mostly done as debt and equity. I found one firm in the world that just does, I think there's two firms in the world that just do rev shares. The key variables, there's really just two. Once you pick debt or equity, or either, no matter whether you pick debt or equity, there's two key variables. One is percentage, what percentage of revenues you're going to take. The norm is a single-digit percentage. And what's your return on investment? In this stage that we're talking about, it's typically 2x. I've seen deals that are 1.5. I've seen deals that are 1.2, usually a little bit later and in growth stage. Sometimes I've seen them in impact investing where it's just lower because they discount for impact. But usually around 2x. That's a good place just to start with. And then the deals can have anything else on them, just like any other early stage investment. So besides debt or equity, you can have this residual equity piece. So that's why I like the half buyback as equity, so that there's upside in case something good happens in terms of acquisitions. I've seen revenue-based loans that have warrants attached to them. It's more complicated, but it's been done. I've seen deals where the buybacks are not mandatory, where they're optional. On either side, I've seen them. And then every other preference that you've seen on a early stage investment, like board seats, liquidation preference, drag along rights, all that other stuff. I've seen that all on these deals as well. Okay, so let's walk through one of these. So let's just assume you found a deal. Maybe you find it this week. You like the team, you like the product or service, you do your due diligence, everything's good. You're all ready to do one of these investments. How do you pick these two variables, percent and payback? So let's just do one with a spreadsheet, and I'll show you how I do it. So let's just assume, for the sake of this exercise, that here are the revenue projections. And it's really rare that you're going to get 10 years of projections. Usually you don't get more than 5. So rough, you're going to have to do some guesswork yourself. In this case, we just stopped growing at year 7 just to see what happens. So there's a spreadsheet here. If you're looking for it, you can find it off of this website down here. And I'll show you how to fill this out. We'll go in little by little. So at the top, we have the total investment. It's $100,000. And we're going to plug in 2x. And it's going to compute for us 200,000, which seems silly. But, if you're doing 1.2 and you're doing a $137,000 loan, it's nice that it computes it for you. In these columns, we're going to put in the projected revenues. And in this case, when you're doing this for real, it's your projected revenues, not the ones they give you. Right? You're an investor. You know they're going to be optimistic because they're entrepreneurs. I know this because I'm an optimistic entrepreneur. Put in the numbers you think are going to happen. And we're just going to look at 10 years because no one's going to invest more than 10 years. This column is just going to compute some growth so we can make sure that these numbers look reasonable. Right? This is the anti-hockey stick. This is a nice company that slowly slows down its growth over time, and that's automatically computed. All right, and then the interesting columns are these 4 over here. So I4 here is just a number we're going to pick out of thin air that says, let's look what happens if we take 3% of revenue. So here's what happens in terms of the cash flows. In year 1, you give out $100,000. And the spreadsheet's doing annual redemptions just because the math's easier. It fits on a screen. And this is because it's shorter. So $100,000 in year 1 goes out. At the beginning of year 2, you get paid 3% of last year's revenues. Right? You can't get paid this year's revenues. You get paid last year's. You get paid with historic revenues always. And so you get 3% of their last year's revenues. That's $7,500. The spreadsheet calculates that for you. And then 10,500 is 3% of 350, 15,000 is 3% of 500, and onward. And it just keeps doing this. And at the bottom, it will sum up what the total is over 10 years. And in this case, it's not quite as much as we were hoping for. And this column here, this row here, computes the internal rate of return. So this would be a 12.4% deal if you took it. But it's not our 2x that we were aiming for, so let's keep trying. So next column over, let's try another scenario. Let's try 5%. And so 12,500 is now 5% of 250. Everything else is plays off of that. And you can see it gets to zero, right? The spreadsheet's smart enough to know when we hit the target we were aiming for, in this case, 200K. And so it adds up to 200,000, right? Just like we wanted. This is basically just check numbers just to make sure. And the internal rate of return of these cash flows is 17.4%. So now we're in that sweet spot. We're between 15 and 20. We're right where we want to be. Well, let's just keep looking. So let's try 7%. Let's see what happens if we take 7%. Now, do note, when we say we're taking off of top line revenues, there's a long discussion on why that is. We'll see if we have time for that. If we're taking 5% of top line revenues, then we're really taking 5% of net margins as well, taking 5% of the profits. So if the company isn't earning more than 5% on the bottom line, then you're taking all the profits or more than all the profits. So to keep in mind how profitable these companies are, 7% starts to be a lot, right? You need a company that's having like 21% net margins, so you're only taking a third of them, right? If they're only making 10, you're taking too much. Anyway, so 7% gets us paid back. And in this case, we can start looking at how long. So you can see that 5% took 7.5 years. This last payment's smaller than that payment. And 7% took 6.5 years. So now you can start to say, well, 21%, that's nice. Maybe that's a little bit too much in terms of 7%. And, how long am I willing to wait to get fully paid back, right? Or paid back twice over? We can start to look at how long it takes to get your capital back and whatnot. But, do I want to wait 7 or 8 years? Maybe I'm not that patient. So let's do one more column. And the last column is 9% here. And 9% gets us paid back in 6 years. So now we have some numbers to play with. There's no reason these have to be odd. We could put in, if we think the answer is somewhere between 5 and 7, we can put in 6 and see what happens. We could put in 5.5 and see what happens. It doesn't have to be an even number either, or whole number. And so you play around with those numbers, and 5 minutes later you get a feel for where the payoff's feeling right to you based on this multiple and this time frame to get fully paid back. And something clicks and you go, let's go with that. Let's toss that out there. And so that's what we do for real when we do these. Now I've done so many, it takes me like 2 minutes. Put it in, number pops out. That looks reasonable. Let's go with that. All right, I know that's a lot of information, but take a moment for a second and think about if you were to do one of these deals for a company with these cash flows and you had $100,000 to do this, how would you do it? Would you go down the debt route or the equity route? Which of these 4 choices would you make? 3, 5, 7, or 9%, or something in between? 2x the right number for you, or is that too high, or is that too low? Are these IRRs too high or too low for you? Which column do you like best? And what else do you need? If you're the investor in one of these deals, what else do you need to put into the deal? You want a board seat? Do you need a whole bunch of covenants, right? The approvals on things that the company's doing? Do you want a right to buy more shares? Do you want a right to do another round? Do you want to give them time before they start paying you? It's called a honeymoon. What happens if the company gets purchased? Do you want to immediately get paid, or you just want them to keep paying you? You want more upside? So I'm just going to give you 2 seconds while I take another drink. So like any early stage deal, there's a whole bunch of other things to worry about. But what's novel here is that it's just a percentage of revenues and a return. And that's it. And just be clear, this works for any company that earns revenues and ultimately eventually makes a profit. It doesn't have to be profitable to start with, because they're just using your revenues to get there. They're using your capital to get there. That's fine. Nothing wrong with that. The equity investments do the same thing. They don't have to be profitable to take your equity investment. So as long as it can earn revenues, you can get paid back. So where does this not work? I've been asked that many times. It doesn't work in medical companies where you're developing a drug and you're going to get acquired if the trials work, but you're never going to have a dime of revenue before you get acquired. There's no need to do that in this. That's really just a lottery ticket investment. This works, but shouldn't be used if you have, in fact, the next Google in front of you. Just invest in them and wait 10 years and let them go public and make a lot of money. You don't need to get payback early on that if you're absolutely sure it's the next Google. Everything else, this works great. So you got an SME, and they're making a small amount of money in a village scale business. Fine, right? There is a number at the top. There's a number in terms of how much money you can put in based on what their profits are to take out, let's say, a third of their profits as repayments. There's an investment to be had there. So you could do micro lending for little businesses using the system. And I've seen a firm out of London where their minimum check size is $5 million. You can do this for vastly big deals as well. This is, in fact, the way that most films are financed. It's the way that a lot of oil wells are financed and mines. It works at scale. It works in big numbers, and it works in little numbers too.